Every billion-dollar company on Earth relies on a system invented more than 500 years ago by a humble monk. Yet almost nobody remembers his name. The accounting method that quietly powers Apple, Amazon, Berkshire Hathaway, and nearly every successful business wasn't created by a CEO, banker, or king. It came from a Franciscan friar during the Renaissance. How could someone with no modern technology shape global business for centuries? Today, we're uncovering Luca Pacioli's remarkable way of thinking, why his ideas still control every profitable company, and how understanding them can immediately improve your own financial decisions. Whether you run a business, invest, or simply want to build wealth, this forgotten lesson may change how you see money forever. But first, we need to understand why history accidentally hid one of business's greatest teachers. Luca Pacioli wasn't famous because he became incredibly wealthy. He became influential because he explained something everyone else used, but few truly understood. Born around 1447 in Italy, he lived during an extraordinary period when trade exploded across Europe. Venice, Florence, and Milan weren't just cities. They were giant business laboratories where merchants financed ships, traded across continents, and managed fortunes without computers or calculators. As a mathematician, teacher, and Franciscan friar, Pacioli studied how successful merchants operated. Instead of inventing an entirely new accounting system, he carefully documented the best practices already proving themselves in the real world. Think of him as the person who wrote the operating manual for business itself. That manual would eventually outlive kingdoms, and its first powerful lesson begins with how he viewed money. Most people think money tells you whether you're rich or poor. Pacioli believed money tells a story. Every coin entering your pocket came from somewhere, and every coin leaving had a destination. His revolutionary mindset was that business wasn't a collection of random transactions. It was a connected system where every action created another consequence. Imagine a perfectly balanced seesaw. If one side goes up, the other must respond. That's exactly how he viewed commerce. Instead of asking, "How much money do I have?" he asked, "What caused this number?" Modern entrepreneurs often chase revenue while ignoring the engine creating it. Pacioli focused on understanding relationships rather than isolated numbers. Once you begin thinking this way, opportunities become much easier to recognize, and that's exactly what the greatest merchants of his era discovered. Merchants around Pacioli didn't become successful because they guessed correctly more often. They simply saw patterns hidden inside numbers that others ignored. Imagine two stores each earning $1 million in annual sales. At first glance, they appear identical, but one earns a 20% profit while the other loses 5% after expenses. Revenue tells one story. The underlying numbers tell another. Pacioli understood that businesses fail when owners mistake activity for progress. He encouraged tracking every movement of money so patterns became impossible to ignore. A merchant could quickly see which customers always paid late, which products quietly lost money, or which trade routes consistently produced larger profits. Numbers became a map instead of a scoreboard. That simple shift transformed bookkeeping into one of history's greatest competitive advantages, and it depended on a surprisingly elegant system. Pacioli's greatest contribution became known as double-entry bookkeeping, but don't let the name fool you. It's actually one of the simplest business ideas ever created. Imagine every dollar wearing a pair of shoes. One shoe always leaves somewhere, and the other always arrives somewhere else. Buy a machine for $10,000, cash decreases by $10,000, while equipment increases by exactly the same amount. Sell a product for $500, cash increases while inventory decreases, and profit changes accordingly. Every transaction creates two connected entries that must stay balanced. If they don't, something is wrong. Picture two buckets connected by a pipe. Water can move between them, but it never disappears. That's the beauty of the system. Instead of trusting memory, business owners could trust mathematics, and mathematics rarely lies. The real power, however, came from the rules governing that system. Pacioli believed discipline creates clarity, and clarity creates better decisions. His first rule was simple: record transactions immediately, because memory fades faster than ink. Second, never mix personal and business money. Draw two circles that barely touch. Once those circles overlap, Confusion spreads everywhere. Third, reconcile your records regularly. Think of checking a map every few miles instead of discovering you're lost after crossing the country. Finally, trust evidence over emotion. If the numbers disagree with your assumptions, investigate the assumptions, not the numbers. Consider a small bakery earning $300 daily but spending $320. Without accurate records, the owner feels busy and successful. With disciplined bookkeeping, the hidden loss becomes obvious before it becomes fatal. Those principles sound straightforward, yet one enormous real-world test would prove whether they could survive outside the classroom. A system isn't valuable until it survives the real world. Pacioli's ideas emerged during one of history's most explosive periods of commerce, when merchants financed voyages that could take years to complete and fortunes regularly disappeared in storms, piracy, or failed markets. Imagine trying to manage dozens of ships carrying different cargoes to different countries without spreadsheets, calculators, or even reliable communication. A single mistake could wipe out years of profit. Double-entry bookkeeping became the merchant's compass. Every investment, debt, payment, and shipment could be tracked instead of guessed. Businesses using disciplined records recovered from setbacks faster because they understood exactly where losses occurred. Those relying on memory often blamed bad luck instead of bad management. The system proved that good decisions begin long before a crisis arrives, but even the best systems can't eliminate every mistake. Pacioli never claimed bookkeeping would guarantee success. He believed it guaranteed something even more valuable: honest feedback. Think about two entrepreneurs who each lose $50,000 launching a new product. The first sees only failure and gives up. The second studies the records and discovers sales were actually profitable, but shipping costs quietly consumed every dollar. That's an entirely different problem to solve. Great businesses don't avoid mistakes, they diagnose them quickly. Modern research from the U.S. Small Business Administration consistently shows that poor financial management remains one of the leading reasons businesses fail. Pacioli understood this centuries earlier. Numbers don't criticize you, they simply reveal reality. When failure becomes information instead of embarrassment, every setback becomes a paid education. That mindset naturally leads to one question: how do you consistently make better decisions before problems appear? Pacioli's decision-making process was surprisingly modern. He refused to make important choices using feelings alone. Imagine a simple traffic light. Green means proceed because the numbers support the decision. Yellow means gather more information. Red means stop because the evidence doesn't justify the risk. Suppose a merchant wants to borrow 1,000 gold coins to expand. Instead of asking, "Can I repay this?" Pacioli would ask, "Will this investment reliably produce more than it costs?" If the loan generated 1,300 coins over time, the decision created value. If it produced only 900, the business became weaker despite growing larger. Size was never the objective, healthy economics were. Every major choice flowed through this simple filter, and that disciplined thinking revealed something most competitors never noticed. Most merchants saw accounting as paperwork. Pacioli saw it as intelligence. That's a profound difference. Imagine two captains sailing identical ships through fog. One stares into the mist hoping to spot danger. The other uses a detailed map showing hidden rocks beneath the water. Both face uncertainty, but only one understands the landscape. Business works the same way. Most owners focus on visible numbers like sales, cash balances, or customer counts. Pacioli focused on relationships hidden underneath those numbers. Rising revenue means little if expenses rise faster. More customers aren't automatically better if each one loses money. The competitive advantage wasn't collecting information, it was connecting information. Today we call that business intelligence or analytics. Pacioli recognized its value 5 centuries before software existed. The question then becomes how ordinary people can apply this thinking themselves. You can summarize Pacioli's philosophy into 5 simple steps that almost anyone can use. First, measure everything important, because what isn't measured eventually becomes invisible. Second, separate facts from assumptions by recording real numbers instead of relying on memory. Third, compare results over time to identify trends rather than isolated events. Fourth, investigate every unexpected change instead of ignoring it. Finally, Improve one small weakness before chasing the next opportunity. Picture 5 gears turning together. Remove one gear, and the entire machine slows down. Consider a freelance designer earning $8,000 each month. After tracking every project, they discover one client generates 40% of revenue but consumes 70% of working hours. Simply replacing that client with 2 better ones dramatically increases profit without working longer. That blueprint still drives some of today's most successful companies. Walk into the headquarters of almost any successful company, and you'll find Pacioli's fingerprints everywhere. Every quarterly earnings report, balance sheet, profit and loss statement, cash flow forecast, investor presentation, and business dashboard traces its roots back to the framework he documented in 1494. Whether executives use Excel, SAP, Oracle, QuickBooks, or sophisticated AI-powered financial software, the underlying logic hasn't changed. McKinsey regularly reports that companies making decisions from high-quality financial data consistently outperform competitors that rely on instinct alone. Technology accelerated the process, but it never replaced the principle. Think of modern software as a race car. Pacioli designed the engine. The dashboard may look different today, yet it still runs on the same timeless idea. The next lesson is equally important because blindly copying history can become just as dangerous as ignoring it. If Luca Pacioli walked into a modern business, he'd recognize the accounting system immediately, but he'd be amazed by the speed. In his time, transactions were handwritten in massive leather-bound ledgers. Today, millions of entries happen automatically every second. Copying his methods exactly would be like navigating with a horse and carriage on an interstate highway. The underlying principle survives, but the tools have evolved. Business now moves faster, regulations are more complex, supply chains span continents, and intangible assets like software and intellectual property often create more value than factories. The lesson isn't to imitate Renaissance bookkeeping, it's to preserve the discipline behind it. Technology should eliminate repetitive work, not thoughtful analysis. Many businesses now collect mountains of data but rarely stop to ask what the data actually means. That's where Pacioli's mindset remains surprisingly rare. Imagine Luca Pacioli starting a business in the age of artificial intelligence. He probably wouldn't ask which AI tool writes the best emails or generates the coolest images. He'd ask a much simpler question: how will I measure whether any of this creates real value? Picture 2 entrepreneurs buying the same AI software for $100 a month. One saves 5 hours every week. The other never changes their workflow. They purchased the same technology, but received completely different returns. Pacioli would insist on measuring time saved, customer satisfaction, profit margins, and return on investment before expanding further. Draw a simple equation. If AI saves 10 hours weekly, worth $75 per hour, that's $750 of value created every week for a $100 monthly subscription. That's not excitement, that's economics. His philosophy reminds us that every innovation should improve the numbers, not simply impress the audience. If you remembered only one idea from Luca Pacioli's life, let it be this: every financial decision creates 2 stories. There's the story you hope is true, and there's the story the numbers actually tell. Wealthy people eventually learn to trust the second story more than the first. Imagine wearing 2 pairs of glasses. One pair shows your assumptions, the other reveals measurable reality. Most people make decisions wearing only the first pair. Pacioli spent his life teaching merchants to switch glasses before risking their fortunes. Whether you're buying rental property, launching a business, investing in stocks, or simply managing your household budget, accurate measurement almost always beats confident guessing. Once you adopt that habit, your financial decisions begin improving almost automatically. That leads directly to one final challenge that extends far beyond accounting. Here's a thought experiment. Suppose someone secretly deleted every financial statement from your business or personal finances. Could you accurately rebuild them from memory? Most people couldn't. That's exactly why Pacioli believed disciplined records create freedom instead of bureaucracy. Every clear decision begins with clear information. This week, pick one area of your financial life, a side business, investment account, monthly spending, or household budget, and measure it more carefully than you ever have before. Don't try to improve it yet. Simply observe it honestly. You'll probably discover patterns you've never noticed, because what we measure inevitably changes how we think. 5 centuries ago, a quiet Franciscan monk showed the world that wealth isn't created by magic. It's built by understanding reality better than everyone else. If you enjoyed uncovering forgotten ideas that still shape modern money, continue with the next episode, where another overlooked genius reveals a timeless principle that could completely change how you think about building wealth. Thanks for watching. If you enjoyed this video, please like, subscribe, and turn on notifications so you don't miss the next one. See you in the next video.